It will be chaos. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, an unrecoverable catastrophe just hit America's biggest banks. And what I want you to understand, this is going to have massive economic implications and send the U.S. economy deep into a financial crisis. I'm going to show you who's behind this and why it's too late to keep the U.S. economy from crashing down. Plus, we have a sponsor for today's show. I'd like to welcome Southside Corp. You can find them on the New York Stock Exchange under the symbol CVM. And if you're a technical trader, you're going to want to check this out because the stock is surging off of oversold levels on some fantastic news. The 9-day moving average is about to cross upward through the 21-day, and this is a huge short-term trading signal that suggests the stock could go up as much as 35%. We'll show you that. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's go to Bloomberg, where he picked today's story up with a headline of the brutal reality of plunging office values of here, and this is going to affect the banks in a big way because I want to take you through the setup and show you what just happened and why this is the next catastrophe that's going to send, again, the U.S. economy deep into the financial crisis. It's all because of one move by one politically motivated organization as the fallout stands to reverberate widely. The past decade of rock bottom rates, global investors piled into offices and other commercial buildings as a perceived safe alternative to bonds, mainly for the cash flow. And one of the big facts about commercial real estate is it tends to hold its value. Even during a recession or financial crisis, the value of buildings don't drop too much. But that's changing now in a big way. It's having an impact on the banks, and as you're seeing, there's nothing they can do about this, as American cities from Los Angeles to New York have counted on top dollar office values to help fill their property tax coffers. And lenders, particularly U.S. regional banks, as we've warned about, are loaded up on these loans for buildings that are now worth a fraction of their initial price. And it's why pockets of distress have cropped up in areas as far away from the U.S. as Germany and even Japan. As more loans near their maturity dates, which is starting this year, and investors write down properties or walk away, lenders across the world will have to stockpile more reserves to deal with possible losses. And when banks raise reserves, and again, this is all coming back to the one move. I'm going to show you who's behind this and why it's too late and just how devastating it's going to be to the banks and the U.S. economy. Because when the banks are facing a loss, when they believe they're going to lose money or potentially lose money, they have to build their reserves, and that means taking profits as cash and setting them aside. But one thing they do with that, well, they buy bonds. That drives interest rates down, something we have predicted would happen and would be led by the banks. But exactly how this plays out for each company will largely depend on the qualities of each of their loan, meaning distress may pop up in different areas at a variety of times, suggesting at the Federal Reserve level, who has said the banking sector is strong and sound, well, based on what we're seeing, there's no sign of it. And then what we see today that happened, well, it changes everything. And as of December, offices accounted for 41% of the value of distressed U.S. properties, which is staggering at around $86 billion. This according to MSCI. Potential distress refers to as the erosion of an asset's current financial standing is nearly at $235 billion across all property types. And while many people say rates are never going to go back down, it's not possible. There's no way the Fed will take rates back down to zero. When you understand that these commercial real estate buildings are going to cause bank failures, there's going to be only one option the Fed has, because they only have two tools in their toolbox. One's to lower the federal funds rate. The other is to do QE. And you start to get a sense of why the Fed has started already backing off their quantitative tightening. They sense something big is coming, and soon. And what we see now is surging distress in the commercial real estate collateralized loan obligation loans is now spurring lenders to rush to repurchase delinquent multifamily mortgages. And here you can see this continues to experience elevated stress. The latest crack emerges the increasing number of delinquencies on multifamily mortgages. And this is critical because when I show you what's going on at America's biggest banks, all of this starts to make sense. When we see this happen, it sows the seed of, at the very least, a recession. And as we saw during, of course, 2008 and 9, an all-out financial crisis, we're seeing it now happen again, and all for the same reasons as before. And in April, about 8.6% of commercial real estate loans bundled into collateralized loan obligations were distressed. That means, of course, either they're late on payments or the banks don't believe the borrower is going to be able to make payments. And that is dangerous because the banks have no margin for error. They've already borrowed billions of dollars from the Fed. They have to start paying that back. As we've talked about in prior shows, they have no margin for error. They're desperate for deposits even, which is why, of course, we know the Treasury Secretary Janet Yellen, starting next month, is going to buy back some of those low-yielding Treasury securities to give interest back into the bank so they can try to attract deposits. And here we see that, of course, distressed CLOs now reach a record high set in January, and this is dangerous. But something that Al should be searching. Let me give you a snapshot of our sponsor here, Sell-Side Corp, again on the New York Stock Exchange under the symbol CVM. And I want you to see they're coming off oversold territory here on the RSI, and the MACD is coming right out of the supply zone and surging higher. And see this green line? This is a 9-day. The red is a 21-day. Traders know when you get a positive cross on that, the stock races up. You can see the volume profile. That is a potential 35% return. Stay tuned to the end of the show or check out the pinned comment or description for more information. As the loans now bundled into CRE CLOs were merged with funds from individual investors to acquire multifamily housing during the COVID era. And after that, borrowing rates surged, of course, on the back of the Federal Reserve. We'll talk more about them in a little bit, catching many off guard because even the Fed did not realize that they were going to raise rates as fast as they did. And normally they go at a very gradual pace, as deliberately done to give the banking system time to adjust. What happened this time? No room for the banks to adjust to this at all. They bought a lot of that low-yielding debt during COVID, and then they got stuck with it. A significant portion of the deteriorating loans had floating interest rates, and well, that's dangerous when rates go up, putting massive pressure on landlord cash flows, diminishing the market worth of properties, and obliterating equity in a large number of investments. According to TREP, $78.5 billion of CRE CLO loans are now outstanding, meaning many issuers are racing to find ways to prevent a tsunami of bad loans from defaulting or risk losing the fees they collect on the securities, and it's all because of something going on in the banking system. I'll show you that here, but I want you to understand the setup. The small banks and even the big banks are under massive stress for all of this commercial real estate loans that they originated, and it's going to have serious economic implications. What I believe, they'll send us into an all-out financial crisis and cause many banks to fail. As the multifamily CRE CLO market was not prepared for rate volatility, no surprise, nobody was. The result is significant distress. The longer the Fed delays rate cuts, the worse the CRE mess will get. And that's the belief as well. If the Fed would just cut rates, everything would be okay. But maybe it wouldn't. Maybe, as I'll show you, it would get worse, because now let's take a look at what's going on inside America's biggest banks that's causing all of this stress, causing all of this economic problems to start to crop up. Why do we not have enough money to pay on all these loans? Something I want you to understand. The way a debt-based economy works is new money is created, and that new money is created through lending, and that goes to pay off old loans. Happens all the time. And if you think about it, you'll understand it. Because where is growth coming from? This is from Zero Hedge. Fed says banks tighten credit standards while loan demand drops further. And this is critical because in a debt-based economy, the commercial banks create money when they originate a new loan. So when the banks decide to curtail their lending activities, well, what happens? It leads to tighter financial conditions, and then more importantly, less money created in the economy. So if you're trying to throttle back the economy, well, getting the banks to originate fewer loans, well, that tends to work. One of the dangerous, then the one critical thing about this, why it leads to catastrophe, is because you need enough money at any given time, not only to sustain the growth rate of the economy that you're hoping to achieve, but to pay on all of the debt. Well, if there isn't enough money to do both, well, next thing you know, you start to see delinquencies go up, and that leads to defaults, and defaults lead, of course, to all-out crises and Fed cutting rates. As we take a look at the first quarter Fed's Senior Loan Officer Opinion Survey. Now, this is one of my favorite quarterly surveys. I love it when this comes out. The one place where every 3 months investors go to find information on changes to both loan demand and bank lending tightness. This was released and revealed on more of the same. Despite the daily propaganda of economic improvement, the sleuths found that more U.S. banks tightened credit standards in the first quarter. And this is dangerous. And what that means is it's even harder to get a loan than before. So if you struggled and if you're trying to get a loan and say, well, just wait, maybe things will get better, they're getting worse. And that's a problem for the banks because the longer they go without originating enough new loans, eventually something in the system breaks. We're seeing that now at a time we have record amount of debt levels. You wonder why we always have crises at record levels of debt? Well, we can blame the Fed, as you're about to see. And of course, loan demand declined, and I'll show you why, mainly because people realized they couldn't get a loan. And of course, without easy credit and without rising loan demand, it's virtually impossible for an economy. We'll qualify that a debt-based economy, especially one that's financialized as the U.S. to grow, and yet we are bombarded day after day suggesting the economy is booming. And taking a closer look at the SLU survey, this was back between March 25th and April 8th, you find a net share of U.S. banks that tighten standards on the all-important commercial industrial lending. This is a big one because it's the commercial banks that create money when they lend. Now, money is destroyed whenever a commercial loan makes a principal payment, whether it's a regular monthly payment or quarterly or even a payoff. That money is destroyed from the system. So even worse, when there isn't enough money or enough new loans to offset the amount of loans being paid down, which happens during, of course, periods of low interest rates. You have a lot of low interest mortgages or low interest loans originated. Well, that means more money on net is being destroyed. That is dangerous. And this, what we're seeing here, that they tighten standards on mid and large-sized businesses, now 15.6% in the first 3 months, that from 14.5% of banks in the fourth quarter. Other types of loans that saw tightening lending standards include new and used auto loan, which is why it's harder to get one of them. Tighter standards at 9.8 from 6.3, and small firm credit from 19.7 to 18.6, suggesting more banks tightening, making it harder to get credit. They want to make sure they get their money back. They're not convinced. And at the same time, credit eased modestly relative, of course, is for credit card loans, construction loans, and multifamily residential loans. And here's the issue, what we see. When we look at the net percentage of domestic banks tightening standards here for commercial industrial loans to firms of all sizes, this is shown in blue. And on net, what's tightening when it's above that horizontal black line, easing when it's below. So I want you to notice here, going into the dot-com bubble, what happened? Banks were tightening standards. What happened going into, of course, the recession before that? Banks were tightening standards. How about the global financial crisis? Banks tightened standards. The little slowdown we saw 2015, 2016, the banks were there too. And how about now? Well, we haven't seen it trigger. Just not yet. And what we can note here is banks tighten standards. You look at commercial industrial lending, this shown on a year-over-year rate of change. What happens is it starts to decelerate and eventually contract. And it's these periods of contraction where banks on net are destroying money. And granted, we're not destroying a lot of it yet, but we are destroying money. That's why we're starting to see, these delinquency rates go up because, of course, that is a problem. And what we note, there isn't enough money to pay on all the loans. And who's the catalyst behind all this? And why is it too late? Well, it's everything to do with the Federal Reserve, because when they raise short-term interest rates higher than the market wants them, that's called inverting the yield curve. And here you can see where 2-year yields, which are very sensitive to the federal funds rate, are higher than 10-year. That shows up anytime they're inverted down here. Now, the market's perception is, well, if rates go down, then everything's okay. And rates go down, you see that red line go up, the yield curve rises. But normally what happens? Banks still tighten lending standards, because what happens then is you see longer-term rates fall along with short-term rates. And the only difference now is the margin that banks have to lend gets thinner and thinner as rates go down. They tighten standards even more until we go into an all-out crisis and the Fed finally backs off and lowers rates less than the market expectation, which they always do. And on the demand side, the picture was mixed as well. While demand declined across the board relative baseline, it did modestly for commercial and industrial loans and credit card loan demand, auto loan demand, and commercial industrial loan demand all dropped sequentially, mainly because people realize they can't get a loan. And part of that has to do with the fact that delinquency rates are rising. So if you're in delinquency, well, the odds of you getting a loan are not good. Here you can see the net percentage of domestic banks tightening standards to firms of all sizes against the delinquency rate on all loans. You see consumer loans in green and then credit cards in purple. And what we can note is during periods where banks are tightening standards, what happens is delinquency rates go up, which validates the fact that the banks aren't creating enough money to sustain the economy and to pay on all the debt. It's only now a matter of time before we see an all-out catastrophe, which is why I started the show with, it will be chaos. As banks have been tightening credit standards since the second quarter of 2022, following a string of high-profile regional bank failures. Of course, that's the excuse. The reality is it's the Fed. As the Fed hiked its rate last year to a two-decade high in a bid to curb inflation. Well, if you're not creating enough money, you're certainly not going to get inflation, and high borrowing costs have weighed on businesses and households. And banks also tightened lending standards for consumers as a significant net share of banks reported increasing the minimum credit score requirement for credit cards, while moderate net share of banks reported doing so for auto loans and other consumer loans. And in summary, the U.S. economy, this from Zero Hedge, remains badly credit constrained on both the supply and demand, and that means, of course, we're likely to head into a financial crisis here because consumers and businesses can't access credit. And we're talking about how the rates fall across the board, and sure enough, here you can see the federal funds rate in blue against 2, 5, 10, and 30-year. When the Fed's cutting, well, usually yields are dropping ahead of the Fed, but when the Fed cuts, everything comes down. That's why lending standards continue to tighten in these cases. But if you ask the Fed, well, Kashkari questions the policy tightening as inflation stalls, suggesting he thinks it's not tight enough. And sure enough, he singled out persistent housing inflation as a potential indicator that neutral interest rates, those that are neither restrict or stimulate the economy, may be higher in the short term, suggesting he thinks they're too low. And that could mean the Fed has more work to do to cool inflation, in an essay he published on his bank's website this week. My colleagues and I are, of course, very happy with the labor market has proved resilient. Well, hang tight on that, Kashkari. But with inflation in the most recent quarter moving sideways, it raises questions about how restrictive policy actually is. And of course, we talk about what he published, another essay back in February, which he said policymakers had time to gauge incoming data before lowering rates, but they don't. And that's the issue here, because when we look at the labor market, we're seeing further signs that things are going wrong. In fact, what do we see from Tesla? More employees now laid off as a bloodbath enters its fourth week. And here we can see Elon Musk said in an email to employees, the company needed to be absolutely hardcore about cuts. And staffers working under executives who don't obviously pass the excellent, necessary, and trustworthy test, well, they're out of the job. Musk privately expressed desire to lay off at least 20% of the company because its quarterly vehicle deliveries fell by that much. And here you can see when banks tighten standards, again, there's just not enough credit to sustain the growth of the economy and pay all the debts. That leads to less demand. Of course, inflation coming down and the all-important continued unemployment claims tends to go higher, which sets the stage now that we know for a fact we're not only headed into a recession, but most likely a deep and protracted financial crisis, as we're going to likely see a lot of commercial real estate and multifamily cause small and mid-sized regional banks to outright fail. But one thing we're very bullish on, that's our sponsor of today's show, Southside Corp. You can find them on the New York Stock Exchange under the symbol CVM. All the information in the description and pinned comment below. Let's take a look at what's going on with the company and what the catalyst is behind this recent stock move that we think could send it up another 35% based on the technicals alone. And here you can see they're dedicated to research and development directed at improving the treatment of cancer, autoimmune, and infectious diseases. Here's from a recent 2024 financial results. They target head and neck cancer patient populations for their product Multikind, and its target population, which saw its 5-year risk of death cut in half, can be identified prior to surgery upon diagnosis with tests that physicians routinely use in cancer screens, a key finding for Multikind. And here you can see, of course, summary of results: 73% survival rate for Multikind versus 45% in the control at 5 years, 28% absolute survival benefit, tumor reduction rate greater than 13%, tumor downstaging greater than 35%. Here's a big one: no safety signals or toxicities versus standard care, and an estimated population of 145,000 patients is, of course, a catalyst of what we see is going to be demand for Multikind. And as we look forward here, their LEAPS vaccine offers promising new paradigm that to treat rheumatoid arthritis. In the article, authors note that the currently available therapeutic arsenal for the treatment of RA consists of mainly immunosuppressive or ablative drugs, which may carry the potential risk of facilitating recurrent or primary infectious disease of cancers. This is, of course, what the goal is. At Cellside, they focus on utilizing a healthy immune system to overcome disease safely and with minimal side effects. And that is, of course, what we see as a driver of their stock. That's even why Zacks Small Cap putting analyst recommendation behind this. Zacks big on, of course, sell side. Here we can see on the New York Stock Exchange symbol CVM. I showed you the bigger picture earlier, but look at this beautiful supply zone here. What do we know? Momentum in terms of the RSI and the MACD rising out of this, price breaking out right above the supply zone, just as it's supposed to do. What we see is when the sellers are done and the buyers have snapped up all of the available stock, what you see is it rises out of there, just as we're seeing in this chart, setting up a move up here to the volume profile line. That would be a 35% move higher up into that upward supply zone. And here you can see on the 30-day chart, you can see right now there's a little battleground between buyers and sellers. This would be the catalyst. If the stock can break through this level, that is the catalyst to send it even higher. And you can zoom into the 10-day where you see the volume profile. It's very clear where the buyers are at on the stock, because again, the market is turning bullish, momentum's turning bullish, and on a technical basis to set up for, of course, sell side. Symbol on the New York Stock Exchange, CVM, is absolutely bullish. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.